Well, I think today's top story is kind of a no-brainer as the Bank of Canada slashing its key interest rate again by another 50 basis points. And this is for the second time in a row. So this now brings the cumulative cut down 175 basis points since the peak of the cycle at 5%. Now, in the video today, I want to break down why the bank made this move, and I want to see what it tells us about the state of the economy. And it does say quite a bit here. So just to recap what happened this morning, the bank's key interest rate is now quite a bit lower after two consecutive 50 basis point cuts. The market did widely expect this decision, but the implications here are stretching beyond just these numbers. This cut and a total now of 1.75 percentage points, that means that the bank is taking decisive action here to steer the economy away from trouble, and they're moving very quickly on this. So let's look at why these cuts today. And this one comes in response mainly to growing signs of the economic weaknesses, the challenges that we're seeing out there. A few things to cover off. First off, the growth indicators we've been seeing are showing some cracks in the economy. We have seen retail sales, they've slowed down. And as far as GDP is concerned, we've generally seen poor growth. Now expansion has slowed. So these rate cuts now are just sort of a way to jumpstart the activity and encouraging borrowing and encouraging spending. The cuts, they're also intended to provide just general financial relief. As we all know, borrowing costs have climbed a lot over the past rate hiking cycle. So this has brought a lot of households to the point where they're struggling. A lot of businesses are in the same situation as well. When we look at mortgage payments, this is always in everybody's mind. Loan obligations, credit costs, these have all surged. And so these cuts now are designed to provide some relief there. As far as immediate impacts are concerned, what is going to change? Well, let's look at what the decision means for Canadians across different financial situations. First of all, I want to start with homeowners. So if you have a variable rate mortgage, you can expect lower monthly rates, lower monthly payments rather, as the banks will adjust their prime lending rates. If you are on a fixed term, so fixed rate borrowers, you could benefit as well when your renewal dates arrive. There's a lot of those coming up in the next year or two, and you could potentially lock in a more favorable rate there. For borrowers in general, so personal loans, lines of credit, even car loans, they could probably will become a little bit cheaper to manage there. With the new lower rates, that will mean reduced interest costs, obviously, and that hopefully will leave a little bit more room in some household budgets out there. Now, for businesses, companies, and particularly small and medium-sized businesses here, they could see cheaper financing for investments or operational expenses, and this could help boost hiring, productivity in the long run in those sectors as well. But I do want to add a word of caution here. No doubt these lower rates, they do provide relief. They could also, and this is my concern, they could encourage excessive borrowing. And if the debt levels climb too high, it could create a whole new financial vulnerability for both households and businesses. And we've seen the trend towards taking on more debt, even with the higher rates. That's something that is becoming more and more of a problem here at home. Now, I do want to take a look at the broader economic effects. So interest rates, they don't just affect individuals. They have these ripple effects throughout the entire economy. And one sector that we're likely to feel the impact quickly is real estate. So these lower borrowing rates, we just kind of talked about them from a personal perspective. When borrowing is cheaper, that could reignite demand in housing. Of course, we're already dealing with high home prices in a lot of parts of Canada. So there is a concern that this could push affordability even further out of reach for either first-time buyers or people who are right on that bubble as to whether they can actually afford to buy a home or not. I also want to talk about inflation risks. And the most obvious thing to me here is these big cuts to the interest rate that will stimulate the economy. That could also fuel inflation. So while we have seen inflation moderate recently, especially when we compare it, for example, to a year ago, it has been rising the past few months. So we're certainly not out of the woods yet. And if we do see a resurgence in the price pressures out there, that could force the bank to reverse course. So we'll have to stay tuned for that. It is definitely a balancing act. It's very delicate. The cuts are aimed to stimulate growth, of course, but if they overdo it, it could result in overheating sectors or rekindling those inflationary pressures. So I guess what it comes down to is what is next. Will this be the last rate cut for a little while? Or are we on the way to more rate cuts? Well, that will largely depend on what the data tells us in the coming months. So if we see these economic indicators I spoke of earlier, GDP growth, employment, consumer spending, if they remain sluggish, further easing could be in the cards. I did want to take just a moment and add a little bit of historic perspective to this, to add some context to the discussion. And we've seen the Bank of Canada make these sharp cuts before. The most obvious example for many of us will be back during the 2008 financial crisis. And we saw the bank cut rates aggressively then. The goal then was to prevent a very deep economic collapse, or even deeper than it was at the time. And there's no question that those cuts did succeed. They stabilized the economy, but they also contributed then to a prolonged period of low interest rates. And then that was sort of where the start of where we saw the record high debt accumulation. So I guess the big question now is, will we be seeing a repeat of that cycle? It's hard to say right now. I do believe that the circumstances today, they're different, but the tools being used to manage it are effectively the same. So the question remains, will this be enough to support the growth without introducing those new risks? Now, I'm curious, what do you think about the bank's approach this time around? Could these cuts spark more growth, or do you think that they risk creating bigger issues down the road? Look forward to your comments below. I want you to picture this. You are looking for an investment that can grow with you, something that's versatile enough to provide both cash flow and growth potential. Maybe you are saving for a big purchase like a new home. Perhaps you're just looking to build a nest egg for your retirement. Well, the BMO Balanced ETF might be just what you need. It is a diversified portfolio. It combines global equity and fixed income ETFs, so it gives you broad market exposure with the potential stability of fixed income. Now, every quarter, the ETF adjusts its asset allocation to ensure that you're always in the optimal position no matter what the market throws at you. So whether you are new to investing, whether you're a seasoned pro, this fund does offer a balanced approach that can help you stay on course toward your financial goals. You can find out how the BMO Balanced ETF can be part of your investment journey. Visit bmoetfs.com today to learn more. The latest U.S. inflation numbers are out this morning as well, and they do show an uptick in November. The annual inflation rate there, it increased to 2.7%. That's up from 2.6% in October. This does come in line with expectations, but the details behind the numbers reveal some interesting shifts here, so I want to take a quick look at those. As I mentioned, inflation ticked up for the second month in a row now. Energy costs, they continue to decline, but at a slower pace. They're down 3.2% compared to October's 4.9% drop. Food prices climbed again, up 2.4%. That's up from 2.1% previously. And new vehicle prices fell only 0.7%. And that's a smaller dip than we saw. The dip was 1.3% in the previous month. Now, while all this is happening, shelter inflation, it did ease slightly. It's down to 4.7%. Transportation costs, they also decelerated. They're now at 7.1%. If we look a little bit deeper at this, gasoline, fuel costs are always a big deal. Gasoline and fuel oil prices, they dropped 8.1% and 19.5% respectively. Monthly inflation, that came in at 0.3%. That is the highest since April. That was driven mainly by shelter, which accounted for 40% of the increase. Finally, on this report, the core CPI, this excludes the volatile food and energy prices. It held steady at 3.3% year over year and 0.3% month over month. So that is definitely a ton of data, but it's fresh this morning. It's relevant to us as investors, so hopefully you can soak it all in. According to the latest report out from rentals.ca and Urbanation, believe it or not, rent in Canada hit a 15-month low in November. The average price dropped to $2,139. Now, I know a lot of people don't feel this, and if you're in a contract already, you're not going to benefit by this, but for new people going out there into the market, the stats show rental prices are coming down. Now, while this trend is a good thing, average rents are still up 6.7% from 2 years ago and nearly 19% from 3 years ago, so that's a reflection of the long-term growth trends. More specifically, 1 and 2 bedroom apartment rents, they fell in November, dropping 1.2% and 1% respectively. They're now at $1,921 and $2,302. When you look at studio and 3 bedroom apartments, they bucked that trend. They rose 5% and 5.1% annually. When we look at purpose-built apartments, they grew slightly overall, but 1 bedroom units in this category dropped to 0.6%. Condo apartment rents, they fell by 4% on average. We're seeing 2 bedroom units with the steepest drop, 4.3%. and that price now lands at $2,344. Now, the exception here was three-bedroom condos, and we saw a modest 1.9% increase there, averaging $2,936. So when we look at this trend over the past 5 years, Canadian rents have grown an average annual rate of 3.4%, and that's even when you factor in these recent declines. So what does this all mean? Well, we are definitely seeing some shorter-term reprieve for new renters. This doesn't affect, as I mentioned earlier, the existing contracts, and generally it highlights a resilience in the overall housing market. International Air Transport Association, IATA, it is now projecting global airline revenue to exceed $1 trillion by 2025, and it's expecting passenger numbers to hit a record 5.2 billion. Now, that said, the airlines, they are still struggling to expand due to delays in jet deliveries caused by some major issues, and we really think, for front of the mind here, the Boeing issues, but also at Airbus. And IATA Director General Willie Walsh, he criticized the situation, and he notes that the supply chain problems, in other words, what he's saying by that, without newer, more efficient airplanes, this hinders the airline's ability to cut fuel costs. He said, "We've given them time. I think our patience has run out. The situation is unacceptable." And he accused suppliers of acting like quasi-monopolies and benefiting from the chaos that they themselves have caused, including the higher prices for spare parts. Now, Airbus, it has reduced its delivery targets. Boeing is facing horribly slow production because of the strikes and then the regulatory scrutiny that they're under there. They're finally sort of starting to get their production back up to speed. On this topic, he says, "We're going to have to ramp up the pressure and maybe look for support to force key suppliers to get their act together." Now, the industry as a whole did see a very nice rebound from the pandemic. During those years, there was a loss of $140 billion. Well, that was actually in 2020. And IATA forecasts profits now of $36.6 billion in 2025. That's driven by what they're saying is robust travel demand and this projected drop in jet fuel prices. When we look at potential risks, though, to the industry, these include the Middle Eastern and Ukrainian conflicts. Those are a big effect there, as well as the trade tariffs that could dampen some confidence when it comes to the business itself. Passenger yields, they're expected to fall by 3.4% in 2025, and that is a sign of growing cost pressures, even in light of expected growth in revenues. That is a wrap for today's program, but don't forget that you can listen to these episodes on your favorite podcast carrier as well, so be sure to check that. I will put a link right here. As always, I thank you for watching. I'll see you in the next video.